You mentioned the course that the United States is taking, the financial course that we're following. Can you expand on the imbalances that this is creating in the world, the financial world?
Well, basically, we had a boom in the high-tech and telecommunication media sector in the late 1990s, and we had the NASDAQ bubble. And both came apart in March 2000. And then the Federal Reserve became concerned that we could have a deflationary recession. And so they pursued an ultra-expansionary monetary policies. The Fed fund rate was cut from 6.5% to 1%. And this led to very strong debt growth and to the asset inflation, which was particularly apparent in the US housing market and also to some extent the recovery in stock prices. Now this then led to strong consumption growth, which was, however, not accompanied by industrial production growth or by capital spending increases. And so you have consumption growing, but not industrial production. That then leads to a trade and current account deficit. The production and the investments then shift to China, and the Chinese then accumulate reserves, money in the hands of the central bank, which they lend back in the form of purchases of US securities. And obviously this game cannot last forever. It can last for a long time, as it has already, but it won't last forever. And also the implication is obviously that whereas in the US asset prices can go up, like this year the S&P 500 or the Dow are up between 12 and 15%, but expressed in euro, in other words, in a relatively stronger currency, the S&P is up just 1.5% and the Dow Jones just 3%. And bond prices in the US, of course, in euro terms are down. And in terms of gold, since Mr. Bernanke has been elected, the Dow is up 15%, but the price of gold is up 36%. So in terms of gold, the Dow is going down, the dollar is going down. And this is one of the worst performing commodities. Had you invested, say, when Mr. Bernanke was elected as Fed chairman, had you invested in silver, in lead, tin, zinc, nickel, copper, you would have done much better. So basically, the US Federal Reserve doesn't care where the value of the dollar is, and we have to see one point very clearly. What is happening in the US is a huge wealth transfer from the middle class, from the working class, from honest, decent people to essentially Wall Street and to the asset shufflers on Wall Street and to the politicians. Because this year, you take the 5 largest brokerage firms on Wall Street: Goldman Sachs, Morgan Stanley, Merrill Lynch, Lehman, and Bear Stearns. They will pay out $36 billion in bonuses. They have 173,000 employees. With the compensation these employees get outside the bonus pool, together, these 173,000 people will have, as an example, a larger income than the entire economy of Vietnam with 84 million people.
Wow.
And of course, if you shift money from the middle classes and the poor in America, say the Walmart shoppers, to the rich, the elite, the asset shufflers, the people that are on the Forbes list of the 400 richest Americans, you get a dual economy. You get one economy for the people, for the masses, and you get one economy for the elite, that are the people that are in luxury hotels, that have Park Avenue apartments, that are in Palm Beach, and so forth and so on. And it creates a very unhealthy imbalance for society as a whole.
You mentioned that the U.S. currency is going down. Historically, looking back, what would that look like today if you were to compare it to?
Well, I think that we have reached a point in the United States where the indebtedness of the U.S., in other words, credit, is now over 330% of GDP, and we have inflated assets. I think the U.S. has no other option but to print money. And if you print money, the value of your currency will eventually decline. The question, will it decline against the euro, the yen, the Chinese currency, or say gold? I think it will go down mostly against gold, because the other central bankers could also print money and have been printing money and so forth. But in general, what you then end up with is very high inflation rates. In other words, a very sharp depreciation of the purchasing power of the dollar. Purchasing power can be lost either as consumer prices go up, so you can buy less and less consumer goods with the same dollar, or it can be lost as asset prices go up compared to, say, cash. And I think both will play a role, and that in the long run, money in the US will pretty much become worthless.
So you think there's a possibility then of an end game with a hyperinflation?
Yes, I think that is very likely, yes, very likely.
You think that you could see, this is a $100 million of phony $1 million bills that are available on the internet. But you think that this $100 million stack could equal this or even more?
Yes, is entirely possible. I mean, in Germany, in the hyperinflation years 1918 to 23, in local currency terms, an index of share prices went from, say, 100 to several $1 trillion. But because the currency depreciation was higher than the appreciation in local shares, in gold and in foreign currency terms, the market went down from 100 to 2.
Wow.
So you get a deflation through